Hello and welcome to another episode of the Stock Market Today video. We're coming to you live as we typically do after the market close. And today is September 19th, 2025. My name is Justin Nielsen. I'm going to be your host today. And joining me, as he usually does on a Friday, is our senior market strategist, Mike Webster. How you doing, Mike?
I just feel like a senior right now. We'll just go with that.
Okay. A senior in high school?
A senior, just tired senior, and like
Okay, very
worn
good.
out. It's a
Uh,
Friday,
well,
man.
I mean, man, it's been a week, right? We had the Fed earlier this week, so there was a lot of focus on that. We had some economic data, and we just had a market that continues climbing higher. Some really interesting moves for the indexes today. So we'll be going all over that, and we're going to revisit that 1980 precedent because if you're feeling like a senior, why not go back to the 80s to really think a little bit hard about where we're at in our current um, in our current evolution of this market rally. But before we do that, just so you know, we're going to be covering a few stocks today. Do you remember what they are, Mike?
Dude.
Yeah, so we're
No.
going to cover Robinhood, Oracle, and Broadcom. So that's HOOD, ORCL, and AVGO. But first, let's take a look at the indexes. We'll go ahead and I'll share my screen real quick here. And there we go. So we've got the NASDAQ composite. I'm going to move this over real quick. We've got the NASDAQ composite that is closed up 0.7% today. It looks like, yeah, 0.7%. The S&P 500 up 0.5%. The Russell 2000, that was down after having a really strong week, down a little bit, 0.8%, and the Dow Jones Industrial Average up 0.4%.
Your
So,
charts
Mike,
aren't changing for me.
you know what?
Normal.
Because I was looking at my numbers.
Oh, okay,
Yeah,
gotcha.
so we'll get to it right now. Let's start with the Nasdaq, and maybe you could kind of talk a little bit of what happened this week and why it was good and why you're concerned.
Well, if you just look at the chart, everything looks great. There's really nothing to be concerned about. It, whenever you start getting stretched beyond the 21 day, you are cognizant of that. But just looking at the chart, everything looks really good. The only issue that I have is that precedent, and we'll talk about that a little bit later. But let's table that for now and just look at the reality of what we've got going on. The biggest thing was getting through the Fed this week. I think everyone and their brother knew that he was only going to do a quarter point. So it wasn't about, some people always, think maybe he wouldn't do anything or do a half, but I think that was a really small minority of folks who thought that. So he did what we thought. And so then you get this relief rally, but more importantly, he didn't throw any monkey wrenches in there. If you listen to what he said, he's really wants to go at a measured pace. Is the reading between the lines, reading the speak of Powell, which I just love listening to him and interpreting him. And I just take it as he reluctantly did this, but he was leaning on the fact that the job revisions and everything that happened, that he kind of was forced to start cutting. But I wouldn't be surprised if we start getting better employment numbers. They only do one this year, but I think most people, myself included, think that they're going to do two more cuts this year unless we get a major change in the numbers, in the economic data that comes out, or inflation goes way up, or what have you. But so that's your base case. So the market doesn't have to really worry anymore. It's kind of on cruise control or full self-driving, so to speak, into the year end. And then of course he's retiring next year. So you've got this big risk element that's off the table, and we're pretty far in on all the tariff stuff. There's still new tariff stuff that pops up here and there, but it is not as big of a deal as it was earlier this year. So now you're just kind of going off of the normal stuff, the normal news that flows through sales or earnings and things like that, and the rest of the economy, and all of that seems to be working. And just look at the market. It's at new highs, and really getting through the Powell thing was the one kind of like wild card that he could have said something that would have thrown the market in a tizzy, but he didn't. and he doesn't want to. He's getting ready to retire, and he wants to leave on a high note, as anyone would when you retire. So we've got that going for us, and so you don't want to overthink it, but we will talk about that precedent later. So this one looks good, but really where the focus is, even though it had a bad day, let's go to the IWM. I do have a position in that, and we do have it on Swing Trader. Yes,
I do as well.
it was down today, and it kind of had a weird day on Thursday or on Wednesday. That wild day, and then kind of stalling action. But we came back and closed above the
Yeah, it was
high.
it was a really fast jump. Um, yeah, it was just kind of very brief and then right back down. So yeah, that was a kind of weird action there.
And it was wild when it's 2,000 stocks and it has that big of a move. Like so that tells you it's your algos that are moving,
Mhm.
moving the market a lot more than you would think, or a lot of
And it could be
ETF.
with futures, options, all of these different things that kind of, again, force the arbitrage to adjust accordingly, right?
Exactly. And you and I and Justin and Charles did a lot of work on stalling days with Bill O'Neill, the founder of IBD. And one of the things that we noticed, not necessarily with stalling, but with downside reversals, that if you can close above the high of the downside reversal the next day or the day after that, kind of negates that action. So even though that wasn't really a downside reversal as much as it was kind of this weird stalling action on Wednesday, the fact that we were able to close above the high yesterday kind of says, okay, it's a one-off, no big deal. So this looks good, and this is where I think the leadership is going forward. What is so nice, and I was not expecting this. Let's go to the cues. Was for the rest of the market to continue on. I thought it was going to be passing the baton on from the Nasdaq and the Fang names into the small caps, but really it's in everything market for the
Mhm.
most part. That's great. I really did not see that coming. I thought one would pause. It doesn't want to pause, so you don't fight the market. You just go with it, and so it looks good. Let's go over to the SPY
Yeah,
to
you
see if
normally
there's any.
think of the money moving from one area to another, but as you pointed out, I mean, if we just take a look at FNGS, which is the Fang Plus ETF, I mean, this is
Yeah,
at highs. It's not like the money is moving out of here to go to the small caps. It's doing both, right?
yeah,
But yeah,
and some of
let's.
the slower, pokier ones, like an Apple. Let's pull that
Mhm.
up, and it had some news this week with the, new iPhones and all that stuff. But when something like this is starting to move again, and it's getting near the left side of the base, as it moves up the right side of this base. So, if that breaks out, let's go to the weekly. That could really help the market because it's part of the Dow, part of the S&P, part of the
Mhm.
Qs, part of the Nasdaq, and that could help pull things up. You've got Google looking good. You've got, I think I have a position in that, or no, I don't. But that looks great. So as long as these megas don't fall apart, all is good. And
Mhm.
you always want to be careful when everything is looking good because sometimes danger is at your door. But you take it one day at a time. And right now, bull market. And as we were talking about earlier, let's go back to the NASDAQ, that we restarted our power trend this week. Do you want to talk about the power trend turning off and going back on?
Yeah, it was a little bit of an unusual situation because it didn't turn off because we didn't get the 21-day below the 50-day moving average line. It went to an under pressure condition. And the reason, and it happened right here on August 13th, was because there was just a buildup of stalling. And that in combination with a couple distribution days led to what we call a distribution cluster. And so that's usually a place where we're going to say, okay, yes, the power trend is in place, but we want to be a little bit of, we want to add a little bit of caution there when we get that kind of distribution cluster. It's one thing when you get it spread out over a long period of time, but when you really get it kind of in a short period of time, that's something we really want to pay attention to. And so that's what happened there. And of course, we came down below our 21-day moving average line. We were, testing that a couple times, almost down to the 50-day moving average line. So what we were waiting for was for that to turn back on from the under pressure condition, and we needed 10 days above the 21-day moving average line with the low above the 21-day moving average line in order to get that. And this was actually our 10th day right here, but it was down just slightly. I mean, basically flat. But one of our rules is that we're not going to turn the power trend on unless it's an up day, right? We just want to make sure that it's got that power, that is deserving of the name power trend. So didn't turn on that day, didn't turn on this day because that was also a pink day. So that did turn on here yesterday, because again, we had all of the elements in place with the 21-day above the 50-day moving average line for well over 5 days. I mean, it happened all the way back here. Now we had our 10 days with the low above the 21-day moving average line. Our 50-day line was still in an uptrend. So all of those elements, we just were waiting for that positive day, and we got it yesterday. So power trend back on. What that means is that we try to slow our selling down a little bit. If we have a lot of buy signals, we'll say, okay, we're building a little bit of a cushion. It'll slow our selling down a little bit, and just keeps us a little bit more invested because we're trending so nicely. And look, that doesn't mean that there aren't going to be any pullbacks. As we saw recently, you can get some decent pullbacks, and it might shake you out of some of your positions. But again, you want to be looking at those potential positions that maybe you can hold through. You've got a lot of cushion on, and that's the idea behind that.
Yeah, and so for more on the power trend, I mean that's something that you and I came up with Charles Harris, who you're going to be talking with tomorrow at an event that we can talk about later in the show. But if you want more on that, there's some stuff on our website as well as on YouTube. But there's also a market school home study that the three of us put together that kind of goes over the nitty gritty of what that means. But let's go to the IWM for a second because we've got a power trend on there as well, and this is a fresher power trend that we have. It's been on for a little bit, but again, with a power trend, it's very important. Your low being above your 21 day for 10 consecutive days and closing up is the hardest part to get, but also your 21 day above your 50-day for at least 5 days. And those are your key things. So those two things are really the bulk of it. And it's something that the three of us just noticed at the beginning of really long moves, and you never know how long those are going to go. And so this one, even though it had a lot of it early on, it feels fresher now because you'd come down, you'd gone underneath the 50-day and everything, and it just feels newer, and it feels like it has a little bit more legs. But I might be talking my own book, so to speak.
Well,
But
but also
we'll
part
see.
of that is, I think, having to do with this weekly chart where it just seems like when you say fresher, it's kind of coming out of an area as opposed to being as extended. And I mean, look, even the Nasdaq, when you look at the weekly chart, um, if you do consider that it got to new high area right here around 20,000, it's maybe not as extended as you would think. If you were looking at, oh well, gosh, it went from 14,000 back here in April to now, closing in on 23,000. I mean, that seems like, wow, that's just, such a move. But if you really think of it from this 20,000, it seems newer. But as you said, IWM, the Russell 2000, just seems a little bit fresher in that regard, a little bit closer to that base.
Yeah, and I like the way that you did if go back to the Nasdaq weekly. And I think that's something I always do. And I think people should get in the habit of doing that, whether you're looking at an index chart or a stock chart. Many times when it's breaking out of a base, a cup with handle, let's say, as that one was a V-shaped cup with handle, people think, oh, it's already up so far off the bottom. And you want to forget about that. You really want to think from the breakout. That is a real move because the move up the right side of a base, that's a recovery phase. It's a different
Hmm.
part of what's going on. And obviously we don't have time to get into all of that right now, but just keep it simple, look at it from the old highs, that move up, and you'll not think that we're at this nosebleed territory that you would feel if you're saying, "Oh wow, we were at 14,700. Now we're all the way up here."
Hmm.
Um, so
Yeah. Let's talk a little bit about some of these sectors, if you don't mind. I'm going to go ahead and, um, go back to SPY. So just as, oh, you know what? Before we get there, I'm sorry. I also wanted to cover RSP because I thought it was worth mentioning how the breadth has been looking when viewing it from the equal weighted S&P 500.
not a fan, but go to QQEW for a second, because I find this interesting. I really like the equal weight. So the equal weight of the Nasdaq looks, or the Qs, which this is, looks so much better than the RSP. And what I'm focusing in on, not really the RS line, because that always lags with these equal weights, or almost always lags. It's the distance between the low and the 21 day. So this is very healthy, and it's just starting to break out. So it's saying your average stock in the Qs is starting to break out. Now let's go over to the RSP and look at that one. And that is, you know, got to call it the way you see it. It's a negative, right? That it's not moving, and you've got this divergence between what the major averages are doing, market cap weighted, and what this is doing. But it's still above the 21 day, and the 21 day is still above the 50 and all. So it's okay. It's just not ideal.
Hmm.
You would really want more power from your average stock. So that tells you one thing that you can do over the weekend, and I do this every weekend, is play through the entire all the stocks in the S&P 500 and just sort it by sector, and just look and see what's moving. And they're not equally represented when you just look at the number of them. So sometimes the which sector is hot can also impact something like an RSP that's an equal weight of 500 stocks.
Hmm. Well, let's take a look. Speaking of sectors, let's take a look at some of those sectors right now. And I'm just going to throw up IBIT real quick. I do have a position in Bitcoin. This one's been a little bit tricky, in terms of a lot of back and forth here around the 50-day moving average line. Any thoughts on this? This was what was, of kind of these ETFs that we're going to look at, the one that was down the most today.
Yeah, it's just base building. I don't have a position in it, but if it breaks out again, I'll give it a shot. I think that Ethereum has been stronger, and I tried it a few times, and it just doesn't seem to want to go yet. But this one looks so much stronger in that
Hmm.
same space. So that day that we had like a week ago, where it looks so beautiful, and I was in it, and then it fails the next day, and just yeah, not that we that just 1 week
Oh,
ago, that
yeah,
little
this one right
right
here.
there.
Yeah.
I was getting hot and heavy on this one. I thought we were off to the races, and then boom, all of a sudden the next day it just pulled right back in. And so it's just base building, and if this can break out above, really that high, I'll probably give it another shot. It just looks stronger than the IBIT to me.
Hmm. Yeah, and I mean it really kind of started, and I do have a position here in ETHA. But yeah, it kind of started here, but it has been a lot of back and forth. Each time it seems like it's about ready to go, it's like, well, maybe not yet. So, um, energy. I mean, oil and gas. This one is a tough one to play. It still has the relative strength, really lagging. I mean, it's above its 50-day and 200-day moving average line, but it just doesn't look as strong as a lot of the other areas. You know what? I'm also going to put an XBI because this one has been a little bit tricky. Looked really interesting as it was coming out of this base here, and getting back above its 200-day moving average line. But it's been a little bit of fits and starts, so a little bit tough there. XLRE, uh, another one that's been a little bit tough. We were looking at ITB and the housing stocks. Even today, it looked like it was potentially looking at an upside reversal, but it's still not quite ready yet. So
Yeah, well, let's go back
XLRE.
to the ITB for a second.
Hmm.
I was really convinced that this was going to move and have a big move, and I had a big position in there. But as it was proving my thesis wrong, was slowly getting out of that. And it was, it was hard to, when you have a thesis and you think something's going to work, it's always hard to sell. And it was hard to sell. But now I'm just waiting for it to set back up because the thesis is still there, but I'm wrong, and you have
Hmm.
to be able to admit that in the market that you're wrong, your timing was off, or you're just dead wrong. So you wait for it to set back up. And really that day from on Wednesday, that action is just weird. Let's go to the XHB, which is just the home builders. And this one too, it has that same look. So you just want to you want to let it prove itself, and it kind of needs some time in there or a really powerful move. So yeah,
Hmm.
sometimes it doesn't work out, man.
Yeah, I'm with you there. Um, and you know what? I had a position in nail, which is the triple leverage. So that kind of makes you really hone in on making sure you don't hold on to a thesis that's no longer working. Because when you
Yeah,
have a triple leveraged,
you
you need to make that decision very quickly.
Yeah, and for anything, whether you're trading Qs, spies,
Yeah.
or TNA, anything that is a triple, you exactly right. You just have to be very, very careful, or just dial back to the singles. So I will go from a single to a triple, just depending on the account and the conviction, and if it's working. If it's not working, I'll go down to a single and then exit.
Hmm. SMH, the chips, for as strong as some of these look, it's a little bit of a mixed bag. This was down today, which is again unusual with the Nasdaq being up so much. So down 0.4%. Any thoughts here?
It is really a mixed bag in the space, and which is a bit unusual, that the divergence you're seeing from some of the majors. So what I would suggest everyone do over the weekend is play through the whole chip space and kind of see, what is going on there. And sometimes, it is better to trade the ETF as part of it. So if the stock you're in gets some negative news that just comes out of the blue, you at least have some exposure in the ones that are working. So I like doing a combo of picking my favorites and then going with it with an ETF for a little extra juice.
Yeah, it's almost like you're creating your own ETF with your own,
Yep,
your own weightings, right? So,
that's
uh,
exactly right. Yeah.
yeah. So XLP, the staples. Well, look, if you're going to have something be down, you kind of want it to be the defensive areas, and consumer staples definitely hits the boat on that. This has been coming in. Again, this is kind of what you want to see. You want to see the money not hiding here, but getting flowing into the areas of growth, at least for our type of investing. XLV, another kind of defensive area, that's still stuck below the 200-day moving average line. Pretty poor relative strength there. So XBI and the biotech space is definitely a better place to be there. Just looks stronger, as we covered that earlier. XLB, the materials just kind of hanging out right there on its 50-day moving average line. Yeah, again, not a great look for the relative strength. There are some that are looking interesting there, but it's kind of a mixed bag. We talked about QQEW already. That again was fairly flat, but nice setup looking there. XLF, the financials, that was up 0.2%, and certainly this area. Not going necessarily very fast, but it does seem to be trending very nicely and holding mostly above its 21 and 50-day moving average lines. What do you think?
Yeah, the only thing is the divergence of the RS line versus what it's doing. But I don't have anything in that space right now. And looking at this makes me want to have a little bit, to buffer out those bad days when the tech and all the stuff that we're trading is getting killed. Many times the Goldman Sachs and the Morgan Stanleys and the JP Morgans of the world hold up a little bit better. But go to MA, for example. Um, you know,
Which is
this was
MasterCard.
one of
Mhm.
the, that's in that bothered me, seeing, that breakout failure. So you really want to pay attention to the big stocks in a sector. If they're having breakout failures, just it's not a good sign.
Mhm.
It really isn't. So then you go hone into the other part of it. So with the XLF, I'd go more towards the
JP Morgan's, your Morgan Stanley's. Did I just lose you, Mike? Oh,
Dude, can you hear me?
yeah. Sounds like
Okay.
you're coming in from a different microphone, but
Okay, let me try that.
yeah. So I was just going through some of the, some of the money center banks, J.P. Morgan, Morgan Stanley, Goldman Sachs, that have a very different look from Mastercard. That seems like where more of the strength is. One of the other areas that we've looked at is, the regional banks. KRE, not quite as strong as, let's say, y- the KBWB, which has been looking a little bit better, and that's a bank
Can you hear
utility.
me?
I can, but it does again sound like a little bit of an echo. Yeah, and
Sugar in
I'm
the
hearing
morning,
myself
man.
echo. So,
Do you want me to leave and come back?
yeah. Well, you know what?
Okay.
Ask Rachel. Have Rachel tell you in
Rachel?
the chat. Yeah.
Okay.
So, okay, and then I'll just go ahead and go through the remainder here of our sectors, and we'll get some of Webby's thoughts when he comes back. He should be back very shortly. So XLI, we've got this again, another one that's in a downtrend for its relative strength. For those that aren't aware of what these lines are here, these are relative strength moving average lines. And Webby has joined me on the podcast before to talk about how when you're trending below those moving average lines, you really kind of want to stay away from those areas. So that's the case there. One area that is trending above its moving average lines on the relative strength is XLY. Of course, this is getting some help from Tesla. I do have a position in Tesla. That's one of the big components there, as is Amazon, but Tesla definitely doing some heavy lifting for XLY. In the same way, XLC, that's been having a nice move. Google, or Alphabet, I should say, is one of the ones that's really helping XLC out. That was, having a nice day, a little bit under 0.5%, but you can see this has been trending very nicely above its 21-day moving average line. Again, SPY was doing quite well with a 0.5% gain today, and XLU, which again, you normally don't think of the utilities as necessarily being a place when growth is doing well. But here we are, right, in the AI adjacent plays where there's so much energy required, and utilities are sometimes a beneficiary in that regard. So XLU doing pretty good. And
Testing. Can you hear me?
yeah, that was loud. You scared me.
Okay.
uh,
Testing.
yep. I still think, Rachel, you might be able to chime in. It still sounds like he's coming in from a different microphone or different setting. Oh, it sounds okay. Okay, perfect. So we just left off on XLU. We went through XLY, XLC, and we were finishing up here on XLK, which was up a full percent. Of course, you've got Microsoft and NVIDIA and Apple as some of the areas here. Um, Microsoft looking better, NVIDIA back above its 50-day moving average line. But your thoughts on XLK, the tech space, really kind of leading things?
Yeah, I'm impressed and surprised, frankly, and go back to the Microsoft because this is what you want to see that with the Microsoft on the earnings that it had, had the downside reversal, and then it's just base building. You want stocks to base build. You don't want stocks to go up in a straight line because that's where you get bubbles. You need the corrective phase. And what I really love about it is that bottom day, the 492.37 that looked terrible that day. And if you were just studying that what would have been normal and natural would have been really a trip down to the 200 day. But it didn't. And that just is a sign of the health of the market. Now, to tell you that, if it's going to act normal and natural, it should stay above this week's low going forward and just continue to round out the right side. And let's go to the NVIDIA that you mentioned. Again, with this one, lots of news flow on there, but it's just base building. And that's what you want to see is a nice little tight flat base. What's the depth on that? Only
11%.
11%. That's really good because it's telling you that it's at an equilibrium and people are putting all the pieces together of all the news flow that's going on and the unknowns and are still happy with it there. So I'm not in NVIDIA. I don't really want to buy it, but if it breaks out, I'll buy it, give it a shot. I'd rather trade some of the other chips, but this is good for the overall market, in my opinion.
Yeah, absolutely. And one of the reasons, yeah, I thought it was just me. I thought Mike was yelling at me, but if he can turn down
How
the
do I
volume
do
a little
that?
bit.
Wait.
We do have Nvidia kind of trending below its moving average line for its relative strength, so that is an issue there. And I went back to Microsoft real quick because as ugly as this looks, I mean, it is only an 11% deep base there. So when you kind of take a look at the weekly, it really isn't that deep. On Microsoft either. So worth noting there. So that's XLK, and some of the areas that were really outperforming today: GLD and GDX. So the gold and the gold miners. Gold miners up 5.2%. Usually with a strong market and all these growth names doing so well, you usually don't think of gold and gold miners as being like accompanying them in their moves. What gives here, Mike?
Yeah, I do. Is it my
Oh, much
volume
better,
better?
much
Okay.
better. Yes.
Um, uh, so I do have a position in GDX. I had been trading this space a little bit, but not heavy enough on that move up. And then when it started coming in, I was like, okay, it would be normal and natural for it to come all the way into the 21 day, and then I'll pick it up there. But yesterday with the upside reversal, as like, not a perfect upside reversal because I would have rather it come in closer to the 21 day, but I gave it a shot there. If you would have told me that this was going to be up 5% today, I would have said, you're crazy, man. That is
Yeah.
just not normal. But you go through all of the ones in there and they look like they just want to move higher. And it's kind of a weird disconnect between what's going on in the crypto space versus gold. And it's like the old timers with the gold and the GDX and everything is that's playing out better. So that's great. You just go with what's working. I was surprised, pleasantly surprised, but it's too extended to buy here. But
Mhm.
it is very odd. I will say that.
Yeah. So another space that was doing well. I kind of skipped over this one. IGV and the software, also doing very well. But the top spot in
And
terms of
I
at
do
least.
have a position in the IGV, and we had added it to Swing Trader this week too.
Absolutely. And one of the top spots in the sectors, of course, was nuclear. So I'm missing this one myself because I actually wrote a column on it this week of how we handle this in Swing Trader, and so I wasn't allowed to buy this because it was something I was writing about. But man, what a move in the nuclear stocks. NLR is
Yeah.
one way to play that, but we've seen a lot of movement in this area.
Yeah, so I do have a position in this. We do have it on Swing Trader. I just want to say congrats to my father, who my parents watched the show, and my dad called me the other day, and with he'd been buying this for the last month or so, and was just talking about strategies of increasing his position. I kind of tried to talk him out of building it as big as quickly as he wanted to. So sorry, Dad, I was wrong about that. But just kudos to him. He's a great stock
Well, that's why he
picker.
never listens to you, right? Yeah. So.
Oh, he listens to me, but he shouldn't have listened to me this time.
Yeah.
But this space is, and go to Oklo. I have some of that, not enough of it. But that you and I were talking about this. This isn't even the biggest part of the NLR ETF. It's just that whole space is so hot right now that and it looks like it's the beginning of something, not the end of something. But anyone who's playing this space, if a stock goes up 28% in a day, you've got to assume that it can go down 35% or more in a day. So you have to position size it, accordingly. But it is the kind of the hot new area.
Yeah, and look, another thing that's interesting about this market is, okay, yes, you have the nuclear stocks going nuclear, if you will, but there are a lot of these areas that are, certainly more risk on. I'm just going to pull up, some of the quantum computer. Here's qubits. You've got what we affectionately call rigatoni. That's been on a tear lately. So there are these. IREN, Irene. I mean, that's just been going up. I mean, it's almost doubled in just a few weeks here. So, you do have some really big moves happening in a lot of stocks, and uh, they are the higher ATR ones, right? So it is a little bit more risky in these names, but they've been paying off for many people, many investors right now. But is that too much of a good thing, Mike?
No, I don't think it is. It's very reminiscent of the 90s where you had
Hmm.
a lot of, and I'm trading some of these too. I was trading this one and some of the other ones, not well because I'm not in them still. And I should be because they didn't break any of my rules. But sometimes when you're playing with fire and you're getting away with it, you just lock it in to move to something that is a better risk reward. But this area looks normal and natural for, and I'm just going to say it affectionately, junk. You know, it is. It's they are junk. There's nothing wrong with trading junk as long as you realize that that's what you're trading. In the 90s, there was a lot of junk that
And as
had.
long as you're managing your risk, right?
Exactly. You have to,
Mhm.
have your position size right, have your rules, but also remember anything that can go up, if it goes up 10% in a day, it can come down 15% in a day.
Mhm.
Keep that in the back of your mind and realize they don't always give you a chance through your stops. Many times they'll just gap down
Yeah.
through them. So just be careful. If you're playing in this space, you're having fun, you're making a lot of money, that's great. But just remember when the music stops, you want to have a chair to sit in. So just there's nothing wrong with taking some profits, but don't do what I did and let them all go. Well, I mean, I have the Oclo and the NLR and stuff, but so much of the junk that I was trading, man, it's just ripped beyond belief. But that's just a healthy risk on market.
Mhm.
And at some point that switch will flip and it'll be risk off, and then those things will come in hard, but they go a lot longer than you think.
Yeah, no, absolutely. Let's go ahead and talk some stocks, and we'll start with Robinhood. I do have a position in this. Um, this does tend to correlate with uh, Bitcoin, but Bitcoin, as we saw, has been struggling a little bit more, and here we have this one kind of diverging in a good way.
Yeah, so we have that on Swing Trader, and I do have a position in it as well. And depending on how you look at this is either really extended or just breaking out. I'm looking at it both ways because the reality is, not too long ago, it was a $30 stock. Now it's a $120 stock. So that's a big move in a short period of time, which is good and bad. It's showing a lot of power, but it's also a lot of risk in there. But let's go back to the daily. I'm looking at this as an ascending base. It's not a textbook one, but you've got three pullbacks. Each of the pullbacks is higher than the prior one, which is something you need for it to be an ascending base. It's a little on the short side for a traditional ascending base that Bill would prefer 9 weeks, 9 to 16 weeks. But in the study work that I did of ascending bases, that this looks very similar, meaning in a typical ascending base, your first two pullbacks will be will be deeper and longer than the last pullback. And typically, the first two pullbacks are about the same percent, give or take. They have the same look and feel to them. Now, what was different about this one is the middle pullback was a little bit longer than normal, and that was with that break um, of the 50-day. But with the break of the 50-day, it was able to tell you that okay, well, there's some support in there, and I think there was support because people were assuming it was going to be getting added to the index, and then it gets the pop on there. But now you have this last little pullback, and so really the pivot was yesterday out of the ascending base, so it's not that far out of there. Uh, but I like how it closed, but we were talking about on the show this morning on IBD Live how I wasn't happy that it wasn't taking out yesterday's high. And that was really bothering me. And I was on the fence of selling it, but I said, let me just wait until the close. And I'm glad that I did because, you know, it this just looks like it wants to go higher, but it's a volatile one, so you've got to be careful and you've got to position size it accordingly.
Mhm. Let's also take a look at Oracle. This is another one that we've been playing off and on Swing Trader. Really just phenomenal move on its last earnings report, up 36% when, again, you consider that this is, almost $1 trillion itself, to have that kind of move in a single day is pretty impressive. But, it's very hard to buy something knowing that again, this is very normal and natural, as you like to say, Mike, for it to kind of come in, fill in part of the gap, and it really didn't even fill in that much of the gap. But this is kind of looking interesting here now as it's getting support around 300. So how should someone take a look at this as potentially actionable?
Yeah. So
Hmm.
I do have a position in this, and that I bought back today. We tried it on Swing Trader a few days ago, and we gave it as much room as we possibly could. Took a bigger loss in it than we wanted to, but we knew that going into it that it had that potential because of the gap up. And many times with gap ups, when you try to get in them, they'll shake you out a few times before you really get that toe hold that you need to pyramid into it. So this firms up some more on Monday. I'll probably just have to sell it in my personal account and add it to Swing Trader because that would, as long as it's not too far out of there, because this is where it should turn and move up. Why do I say that? When you study gap ups that hold like this, is what's happening is at first you get everyone rushing in to get it, and the fund managers in there buying it. At the same time, you get the shorts in there who were short coming into it, trying to make the charts look as ugly as possible to try to break it down. And sometimes they're able to break it just technically, and then all the momentum folks and folks like us get out of it at the same time, and then the chart rolls down and it has the base build. So you never know for sure. And so you have to interpret what's going on it. And today's action was great. Why was it great? Move back above 300, solid close above that, close in the upper part of the range on a Friday, held above yesterday's low. The way we closed yesterday, it could have easily made a trip down to the 21 day and still been fine. But it didn't do that. And so now, really, the next level is that 2 or 3 days ago, that blue downside reversal area. If it goes through that, that's where you want to be adding to it. If you can trade, if you're comfortable trading gap ups, everyone shouldn't. If you're new to trading, don't trade this stock right now. Wait for a normal base. But if you've been around the block a while and you've studied gap ups, then this is pretty textbook looking. Doesn't mean it's going to be easy because it's textbook, but today's the day where you would have wanted to buy it, and then, like I said, adding to it through that level. It shouldn't go back below. If you bought it today, you wouldn't want it to go below yesterday's low because then you don't know how much lower it's going to go. So that's where I'm putting my stop. My ultimate final stop there. You can stop some out at today's low, but yesterday's low, if it breaks that, you don't know how much lower it's going to go. So you just back out of it and get ready to a buyback if it sets up.
Mhm. And I did adjust my volume. I promise you, folks, we do sound checks before we go
Yeah.
live, but sometimes the platform has other ideas for us. It makes adjustments without us. I did not buy this myself. I ran out of time and money. But one of the things I think is so important is, it's very
Time
tough
is
on a
more important than money.
yeah, it's very tough on a day where you get that gap up to know exactly how far you could come in. But now we do have an area, where we can cut our loss, and that's what's really critical. Again, it really comes down to risk management. It's fine to get something, get into something that's not traditional, as long as you can have a way to manage your risk in that regard. Let's also turn our attention here to Broadcom. This is AVGO. I do have a position here. Another big gap up here. Kind of started making some moves, pullback, didn't even come down to the 21-day moving average line, and we have an upside reversal.
Yeah, so I have a position in this, and we put it on Swing Trader today because of the upside reversal that it had. We'll be tight with this one because same thing with the Oracle. If it comes down underneath today's low, we'll probably just give it a little bit of time, but then exit it and be fine getting back into it. So it was a lot weaker than some of the other chips this week, and lots of news going on in the space, but this is normal and natural action after a gap up of this pullback. Having an upside reversal on a Friday is something that I love because then you have a natural exit at today's low. Really, with upside reversals, I like a bigger spread if possible. It makes the chart look better, but from a risk management standpoint, having it smaller is easier because then you know that you're wrong sooner. So
Yeah,
it's like, it
yeah.
is what it is.
But
But
yeah, this would have been very, very normal looking to come, below that 21-day moving average line to a degree. Um, Again, that would have been very, very normal and very natural. So,
yeah,
um,
and even shaking out the low of the gap up day. Because let's go back to Oracle for a second, because you always want to think of the other side of the trade. So if you were short this, what are you thinking? Let's go to the weekly. You're thinking, oh no, this thing is going to run up to $400 and I'm still short this stock. I need to break this stock. So you're looking at your ammo, which is the amount of money that you have, and I'm talking institutional level money, not individual, and trying to break it. So how could you break it? Let's go back to the daily. You break it by taking out that low there on the lowest point that you had, that red day 2 days after that. That's where you would want to press this. So I would wait. If I was short, I would use all the ammo I possibly could to get it down there. Now, if you can't, then you're really stuck. So that's what it's a battleground, and that's what makes
you got to
this.
manage your risk as a short seller too, right?
Yeah, that's why I don't really short much, because that's a hard game, man. Because
Yeah.
the risk is endless. So, anyways, same thing with the Broadcom. If we go back to that, if you were short that, you would be trying to push it down underneath the first day's the gap up low. And as you were saying, it'd be normal and natural to come down to the 21 day. And I would think even push it a little bit further to see if it can firm up there or not. So we'll see how it
Mhm,
plays out next week.
mhm. So before we get into your charts, Webby, want to just revisit the precedent. I'm going to go ahead and pull up the NASDAQ here. We're going to go back in time to 1980, and we'll go to October 31st. Uh, how's this precedent working out?
It's frankly, it's working out perfectly, which really helped us to put on the gas at various times on Swing Trader and in our own counts, because we were using this as a roadmap. And if you want all the details on this, go back to prior SMTs where we go over this in more detail. But anyways, low holding above your 21 day for extended period of time, then your first breaker, your 21 day, where it came down to 185.68, and then it bounced up into new highs. That's exactly what we did in the current market. Then a retest, but not undercutting your original low, so not undercutting the 185, but finding support in and around your 50 day, which is what we did. We didn't come down as low, as bad as this. Let's go out to the next date. So this is where we're at now. So, and this is why we have been gunning it with Swing Trader and pushing it, because we were using this precedent saying this is where we think the market could go. And now we're there pretty much in percent as well as time. Let's go out to what is not good news. Go out to the next date. Yeah. So after that day, if you can point to that, to the 208.29, that's where we're at now. If this precedent holds, this is what we're looking for, something like this, a nasty test of the 50 day and maybe some sideways action. Well,
On a
on
Monday, even
on Monday.
where it
Yes,
starts. Yeah.
I know. So with that said, I I'm got this. I've got like two eyes, one on the current charts, one on this, and just going. I want this to break. So how do we know if it's going to break? And that is if it doesn't fall next week. It doesn't break the 21 day. If it breaks the 21 day next week, then I'm really dialed into this precedent. But if it doesn't, then it's breaking the precedent. And the important thing of using a precedent is when to throw that out. And that's when you would throw it out. So let's hope that we throw it out. Let's put that one in the trash for now.
Right. Yeah. So again, one of those where you don't necessarily want to be right. And I just put together a little Excel. I put
Oh, I
together a
thought you
little
wanted
Excel
me to
thing.
share. I'm sorry.
Yeah, yeah, yeah. So I just put together this little Excel thing that we went over on IBD Live this morning, where we put the 12/31/1980 to 100 and August 20th, 2025 to 100, and this just kind of shows again we're right there at that peak. So if this precedent holds, we might have a little bit of trouble up ahead. But yeah, we're not going to anticipate too much. We're going to be prepared for it, but we don't want to say, oh, let's sell everything, put the canned goods, into the bunker, quite yet, until we know that this precedent is showing evidence that it's got that downside potential as well.
Let's go back real quick before I do my charts. Go back to your NASDAQ if you still have that old data, because I'm going to tell people where to look for clues. Yeah,
this is the wrong one.
Yeah, go to the NASDAQ and go out to just go to the end of December of 80.
Okay.
Okay, so focus in on the 208.29. That's where we're at right now. And you would know to take action because that Monday, that next bar, that red bar, you had definite distribution, big spread closing at the lows. That's your first shot across the bow that you would want to start backing away. But really, you don't know until the day there. Yes, exactly. When you bounce up, you come down to your 21-day, test it, move up, and now it's living in the lower hemisphere of that 50% retracement from the 208.29 down to the low 2 days later, and it can't move back up to new highs. That is your time to exit, and that is the day before it really breaks the 21-day. That's when you want to get very defensive. So if we see sell signals next week, any major distribution or whatever, we're going to be, at least with Swing Trader in my own account, I'm going to be backing away quickly, worried about this. But then if it firms up and goes back up, precedent's gone, and then you just use your normal instruments, which is what we're going to talk about now, my normal instruments.
Which
so I will,
thankfully is showing a little bit of a different picture, right? So
yeah,
far.
a much better picture. So here's our 50% retracement. You can see that, right? I'm not 50 or regression.
The regression channel.
Okay.
Mm-hmm.
So here it is on SPY and the dates that we're using. May 12th for our starting point, and then July 23rd for 50 trading days out. And this is just a line of best fit or regression, whatever you want to call it. And how I use this is when you test the bottom part, it should bounce back. It wants to live at the white line, which is your line of best fit, or just the trend. And so it wants to live up there. But instead of doing that, it's just hugging this negative 0.75 standard deviation. That is weak. Now the market feels super strong, but in this context, it's weak action. And so you just want to have that in the back of your mind that this should really be up here if it was healthy. Kind of like when you look back when it happened in June, you came down to your line and then bounced right up past your white line all the way up to your red dash line. That's normal and natural. This is weak action. Just calling it the way I see it. Let's look at the NASDAQ. Same basic thing there, but a bit stronger. It looks like it wants to go up to your white line. So if it can get up here, which is really, let's call it, 20, a little bit above 23,000 in a short period of time, meaning next week, then it's very healthy in getting back to its normal, line of best fit. Now, I did add this to the IWM, which again, I have a position in. We're starting it at a different point, and this isn't quite 50 days yet. I think you told me it was like 35 days or something.
35 days, right.
35 days. Okay. Starting off on August 1st, going out to today, and we'll keep moving this out until we hit 50 days. And this is textbook. It's just hugging that, its home base or the white line, and that's what you want to see. And it also helps you when you have bad days like today on a relative basis in it, saying, is this abnormal or not? And it's not, because it's just right on that white line. If it starts deviating from that in either way, then we will analyze that at the time. But right now,
and why did you choose August 1st as your starting date?
Okay, because when you're looking for places to use regression, there's you can use the lows, you can use the follow through day. It's a big topic, but and it's a bit of an art mixed with science. And so you want to see when there is a test and regaining a trend, because this is just a way of measuring a trend. And if you look at this from the bottom over here in April, up here, this was one trend that
Hmm.
it had, and then on May 12th, it started a new trend that was kind of this this time frame, but it wasn't trending nicely in a channel, so to
Right.
speak. This
And a
is
lot of
trading.
times, just to remind
Yeah.
folks, that recovery trend can be very steep and unsustainable. And so that's why we make adjustments, knowing that it's unsustainable that early on, especially with the V-shaped recovery. Just based on experience of looking at a lot of these regression channel lines, oh, okay, this is going to need an adjustment here down the road.
Exactly. And I accidentally skipped over our Bob Weir take a step back, where we look at the weekly chart and a weekly candle. And SPY weekly looks beautiful. The textbook looks like it wants to go higher. Absolutely no problems with that candle. And the composite, what's wrong with that candle?
Which one? The current one?
Yeah, the current one.
Do you not like the
Not a
wick on
dang
the bottom?
thing.
Yeah, I mean,
Nothing. It looks
yeah,
perfect. It's perfect. So sometimes you get a perfect candle,
yeah.
and so I look at each one of these charts that we go through to put a mosaic in my head of like what looks really good, what looks really bad, and so it's scary with the precedent that we're using from the 80s, but then you look at this, and the reality is that is a beautiful weekly candle, and there's
And the
not a
one the one the week before too was
yeah.
not bad either.
Exactly, and you can see that the body here is even bigger, it looks,
Yeah.
or than last week, and so the body is the difference between where it opens for the week and where it closes for the week, and you wanna see that building, and that's exactly what it did. So it's as strong as it gets, really. So now
Mhm.
let's go to our 50% retracements, and when you're at new highs, there's not a lot of things to retrace off of. So I was just using the September 2nd one, just as some point in there. No matter how you slice this, when you're at new highs, you're in the northern hemisphere. So we won't even look at the other ones there. Let's look at the levels. We'll start off with SPY. And you can't see the line up there, but the green line is up at the top. So our first area to be concerned with would be the low of this week, a little cautionary at 654 and change. Then our next area would be kind of either the low of the 2nd of September, my parents' 58th anniversary this year, on that day, or the August 20th. Yeah, the August 20th low. They're very similar. And on top of that, it's underneath the 50-day, which is your blue day. So if we were to come down in there, we're looking at an intermediate correction, frankly. Now, a much deeper intermediate correction would be if we retrace all of that going all the way back to the August 1st low of 619.29. If we come in there, you really have to be super defensive, because that's way underneath your 21-day and your 50-day. And that's really bad action. And of course, you always have to have your final line in the sand. I like to put those somewhere around my 200-day. Here's your 200-day here. So I went back and I found that the low from June 23rd or 20th, the 591 and change, that's where you got to throw in the towel, even from a position trading standpoint, in my opinion. Let's look at the composite. Here's the Nasdaq, kind of the same levels. The low from the 17th, so the low from this week, the 22.058, is the first line, and then this on this one I put the high of this structure here, and I would normally have a bunch more lines on here, but I remove them for the show, so it's not too busy, and I try to keep the key ones in there. So when you're doing lines on your charts, you just want to see where are your normal areas of support. If it breaks it through, those could be moving averages, could be key days, sometimes at the top of a basing structure. And that's what this one is here, using the high from the 13th of August. And then, again, the low from the 20th of August, and then the low from the first. Those are your lines in the sand. And then if we come all the way down here underneath the 200-day, we've got real problems on our hands. I'm going to start doing this for the IWM since I think that's the new
Hmm.
leader, or it has the potential to be the new leader. Our first line in the sand is right around this 21 day, and that would be the low here from the 16th. The next line in the sand would be well under, like if it comes all the way down to this level, the 223.69, which is your low from the 20th, then I'm just dead wrong on the small caps coming back, and we'll just throw those out as a potential new leader. Now we are going to do our standard simple chart, just looking at the 21-day moving average and just focusing in on the low versus that. So we strip everything away and we keep it very, very simple and just see, are there any problems here? No problems there. Let's look at the NASDAQ and see if there's any issues there. No issues there, and no issues there with the IWM when you look at it that way. There is one other thing that I want to start adding to this, and this is something that folks can do at home, is just putting a bunch of moving averages on your charts. This is something I normally don't share, but I look at, and I'm a big fan of Fibonacci numbers, so you can just look those up online and Google them. A 3, a 5, an 8, a 13, a 21, a 34, and so on. And that's what all of these are. And all the way down to I think the biggest one is, 233 day moving average. And I just like to see, is each one above the prior one? And that's another sign of just the health of a trend. When a market starts rolling over one by one, you'll start seeing those moving averages start coming in, as it did here in late July. And where it stops gives you some info of how bad that was. And what's interesting, and this is something I don't talk about very often, but the 34-day moving average, these are all exponential, by the way, which is this tan one there. That one works really well. So it might be something that I'd start talking about more, but and it worked really well in this market. And then the same thing.
Is it going to replace the 21 day?
No, 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 no.
Okay.
But it is something to use in the toolbox. That you want to have something between a 21 day and a 50, and that's your perfect level as your 34 in my opinion. And IWM looks good there too, but you can see it hasn't trended as nicely as, let's just look at the composite. And well, this one had some issues in there too, some wiggles and wobbles, but they've been trending or stacked, as some folks like to say, in the proper order for some time. And let me go to our other charts. I'm trying to be fast because I know we were having some technical problems earlier that caused some slowness. Okay, can you see?
I can see your Bob Marley. Oh,
Okay.
now here's the Webby RSI.
Yeah, so the Webby RSI, this is the measurement of your 21-day, your low versus your 21-day expressed in ATRs, which is down here. And so we're just looking for any warning signs. No warning signs there. It's healthy. We would like it to build a little bit more, but there's nothing wrong with, looks like it's a little bit of like a 1.6 or so, 1.6 ATRs that your low is above the 21-day. That's healthy. And let's look at the NASDAQ. This one is getting a lot of power in there. And it's almost at this stage is a little worrisome to be hitting newer highs in where it was. I would have wanted this up around the 2.5 earlier, say a week or two ago. It didn't happen that way. It took a little bit of time to build. It could just be the market needed to get through the Fed. But we'll see that is a little bit of a warning sign in there when it starts poking up to the highest level after it's been trending a while. So we will see. We'll keep an eye on that. And then the excuse me, the IWM, it's building, and we would actually want to see, see this really just stay in this area. It's still a very healthy place to be. We will go over to the Bob Marley, and this is your off high indicator, and this is measuring the green area is within 4 ATRs of your high, yellow is 4 to 8 ATRs, and then the red area is anything worse than that. And you just see that you're living up here near the top. The key levels would be anytime you have a trough in there, when you come down and hit a low, you want to see, can it hold above that? Well, this one, only being, 1.5 ATRs off the high, it's hard to maintain that. So really it's more worried about these two that are about the same. You want to look and see what's the character of the market? Where does it like to get support? And here it likes to get support around, let's call it 2.5 ATRs off the high. Let's look at the NASDAQ. This one, a bit more volatile, and it tends to get support lately at just shy of 4 ATRs. So 3.7 there, 3.5 there, and a little bit better here of just over 3. So let's take a look at the IWM.
I was just going to ask.
Yeah, and there it's, just finally making it back. This one has been a dog for a long time. So every dog.
And again, that's kind of to your point earlier, why this looks maybe a little fresher is because it is coming from these, this kind of corrective phase that it's been in.
Exactly. So those were all the charts.
Well, I think that wraps it up for us this week. So things to think about for our listeners, homework over the weekend, or anything that folks should be thinking about in terms of how to prepare for either case, right? If the precedent plays out or if the precedent breaks, because we know that is absolutely a possibility. And as you said earlier, you're pretty eager to throw that precedent out.
Dude, I want that to be ancient history. The good thing is you always do the mosaic. You put all the pieces together. There were only a couple, besides the precedent, there were only a couple issues in there with everything we saw, right? You had the Webby RSI getting a little bit hot on the NASDAQ. And that was really the only material issue
that we saw. No deal breakers, right?
Yeah, no deal breakers. So when everything looks good, danger might be at your door. We will see. But the song of the week is going to be Come Monday, because come Monday, I want to start throwing out that precedent. We will see how that reaction is. Homework for the weekend. What I would do, if you're hardcore, I would play through the entire S&P 500. Just go on the web, find those symbols, dump them into Market Surge, and sort them by sector first. So what sector? Broad sector, not industry group. Use the broad sector, and just sort that by secondary sort of the composite rating. And just play through those to get a feel for where the money is flowing. Now, if you don't have that type of time, which is fine, then what I would say is do a simple screen, $75 million volume, above $10. So liquidity and price is your primary thing. Exclude any ETFs or closed-end funds. That helps narrow things down. And then look at things that are, at least 8% above your 200-day. Those will get things that are, have been working better. At least 3% above your 50-day and above your 21-day. And just focus in on those. If that is too much merchandise for you, also put a composite in there and maybe do above 80. But a lot of the junk that we're seeing that is moving, by it's going to have low composites because they don't have any earnings primarily, or they have weak earnings history. So I wouldn't use the composite there if you can help it, but you can sort it by composite.
What about relying on maybe a relative strength sort instead? Maybe even a 3-month.
Yeah, you can do the 3-month or the composite. And since I created both of those, I don't have a dog in that fight. So I think that's fine.
Or you have all the dogs in that fight. So
yes, yeah, I would actually do it by ATR, the 21-day ATR in descending order, because then you're going to deal with all the wild and crazy stuff first that you're just observing. And as a general rule, when something has an ATR above 8, you probably don't want to play it unless you've been around the block a while and you understand the risk. The sweet spot is really like 2.5 ATRs and maybe 3 or 4 ATRs. When you get above that, you just want to pay attention that there's risk involved, or increased risk. But take an ATR with a grain of salt. If the stock just had a big gap up on earnings, that is going to artificially inflate that ATR. We use a 21-day look back period. So just any no number is perfect, no measurement is perfect, but just it helps, and that's how I like to sort those. So you're dealing with all the heat first, and then
Mhm.
kind of the middle of the road stuff, slow pokey stuff at the end.
Mhm. Well, that wraps it up for us this weekend. Thank you so much, Webby. But
Yeah, it's fun
Rachel and
working
I,
with you, man.
yeah, Rachel, of course, is in the background as our producer, and she and I both have to get on charts. They just came out,
Oh,
so we're ready to get the paper out. So we're going to shift over to that. But thank you so much for your comments, Webby. And then on the IBD Live during the week. We'll be back here on Friday for another Stock Market Today video. And then don't forget, you can also join us on an advanced buying seminar that we're going to do tomorrow. This is a paid seminar that's going to be with myself, Charles Harris, and Scott St. Clair. But don't worry, if you can't make it tomorrow, this is actually going to be archived. The idea is we want to put all of these advanced buying strategies that we often talk about in a lot of different places just in one place to consolidate it for everybody. So that's going to be tomorrow. You can go to investors.com to sign up for that, or investors.com/IBD Live to take a trial of IBD Live and join us in the morning hours as we go through charts live and see what's moving. So thanks so much for watching today, and have a great weekend, everybody. Take care.